You know, when you hear the name Warren Buffett, it's just legendary. For decades, this Oracle of Omaha has been the absolute gold standard for investing. He took a failing textile mill and somehow turned it into a global powerhouse. But how? I mean, really, how did he do it? How did one guy build this incredible empire on what seems like simple, common sense wisdom, while pretty much everyone else was chasing complexity? Well, that's what we're going to do today. We're going to unpack the method behind the man. And just to get a sense of the sheer scale we're talking about, look at this number. In early 2024, Berkshire Hathaway, that's Buffett's company, was sitting on over $182 billion in cash. And let's be super clear here. That's not the company's total value. That is just its rainy day fund. It's an almost unimaginable pile of cash just waiting for the perfect moment to be put to work. So, okay, that brings us to the big question, right? In a world of crazy algorithms and high-speed trading, how has his simple, straightforward approach not just survived, but absolutely crushed it? So today, we're going to trace the evolution of his method, from its surprisingly simple roots to the powerful, game-changing philosophy that guides Berkshire Hathaway right now. Every great story has a beginning, and for Warren Buffett, that beginning was at Columbia University. His mentor? The one and only Benjamin Graham, the literal father of value investing. And Graham gave Buffett the foundation, the bedrock for his entire financial worldview. This is probably his most famous saying, and it comes straight out of the Ben Graham playbook. Now, this isn't about being scared or timid. It's about a deep, profound sense of discipline. The idea is really simple. You can't win if you're not in the game. Protecting your capital is everything, because making big gains means absolutely nothing if one bad move can wipe you out. So how do you actually avoid losing money? Well, Graham's answer was this core concept, the margin of safety. Basically, it means you do the hard work. You figure out what a business is truly worth, its real intrinsic value. And then you only buy it when the market is having a sale and offers it to you at a huge discount. That discount is your buffer. It's your margin of safety. It protects you from bad luck, and maybe more importantly, from your own dumb mistakes. Graham had this brilliant way of explaining it with his story of Mr. Market. Imagine you have a business partner, Mr. Market, who is, well, he's totally manic depressive. Every single day, he shows up and offers to either buy your shares or sell you his, but his prices are all over the place, driven by his wild mood swings. The lesson? You completely ignore his emotions. You don't get swept up in his panic or his crazy optimism. Instead, you just wait patiently and you use his irrationality. You sell to him when he's euphoric, and you buy from him when he's terrified. So for years, Buffett followed this playbook to a T. He was hunting for what he called cigar butt companies. These beaten-down stocks that had maybe one last puff of value left in them. But then he forged a partnership with a man named Charlie Munger, and that changed absolutely everything. You see, Munger, he didn't quite have the same reverence for Graham that Buffett did. He saw the cracks in a strategy that was only focused on a cheap price tag. Munger argued that the quality of the business itself was getting totally overlooked, and he was about to push Buffett to evolve his thinking in a way that would define the rest of his legendary career. And this right here, this slide, sums up the entire change perfectly. The Graham way was all about finding a bargain, a fair, maybe even mediocre company, but at a wonderful, dirt cheap price. Munger flipped that script. He convinced Buffett that it was so much better to buy a truly wonderful company at just a fair price. This was a huge shift from pure bargain hunting to focusing on the quality of the business above all else. Okay, so theory is one thing, but how does this actually play out in the real world? Well, the absolute perfect case study is Berkshire's purchase of See's Candies back in 1972. This was a deal that Buffett himself admits he would have totally passed on if it weren't for Charlie Munger. All right, let's break this down. On the surface, you've got two businesses. Both are earning a solid $2 million a year. But look at the tangible assets, the physical stuff like factories and equipment. This mundane business has $18 million worth. See's? Only $8 million. Now, a classic Graham investor would look at that mundane business and think, hey, what a bargain. Maybe pay its asset value of $18 million. But Buffett and Munger paid $25 million for See's, way, way more than its physical assets were worth. So why on earth would they do that? The answer, the real magic, lies in what happens next, especially in an inflationary world like the 1970s. See, to keep making the same amount of real money, Both of these companies have to invest more capital just to stay afloat. The cost of everything, inventory, equipment, it's all going up. And here it is. This is where it all clicks. To double its earnings, that mundane, asset-heavy business had to reinvest another $18 million, basically running just to stand still. Its value went up to $36 million, sure, but the owners made zero real gain on that new investment. Now look at C's. It only needed another $8 million to double its earnings. Its value skyrocketed to $50 million, creating a massive $17 million real gain for Berkshire. See the difference? One business just eats capital, and the other one is a gusher. So what was that secret sauce? It's something Buffett calls economic goodwill. This is the value of the See's Candies brand, the customer loyalty, the reputation, the ability to raise prices. It's an invisible asset that you won't find on a balance sheet. And in an inflationary world, this intangible value becomes what Buffett calls the gift that keeps on giving. Its power just keeps growing without needing tons of expensive reinvestment. This is what Charlie Munger taught Buffett was worth paying a premium for. All right. Let's fast forward 50 years, and this Munger-influenced philosophy is more vital to Berkshire than ever before. You can see the lessons they learned from a little candy company playing out in the massive decisions they're making today. At the 2024 annual meeting, you didn't hear Buffett talking about cheap stocks. He talked about wonderful businesses. And listen to how he praises Apple as an even better business than Coke. That shows you just how much he values companies with these incredible consumer franchises. They're the modern-day See's Candies, just, on a $1 trillion scale. It's the same principle. So you might be thinking, wait a minute, if Apple is so great, why did Berkshire sell some of its stock in 2024? Well, Buffett was really clear about this. It wasn't because his opinion of the business changed at all. Nope. It was a purely rational, practical calculation. He thinks taxes are probably going to go up in the future, so it just makes sense to lock in some of those gains now at a lower tax rate. It's that classic long-term, practical thinking in action. And you see this core discipline in all the other takeaways from the meeting. His caution about AI? Well, that's just avoiding what you don't fully understand. The super clear succession plan? That's thinking about the very long term. And that giant pile of cash we talked about, that's the ultimate patience, just waiting for the perfect pitch to swing at, exactly like he's been doing for over 60 years. And that's the thing. When you zoom out, this philosophy that was built over decades, it goes so far beyond just investing. It's really broadened into a practical, profound guide for business and honestly, for life. I love this one. It's all about resilience. His point is that success isn't about being perfect. It's about avoiding that one catastrophic mistake that takes you out of the game entirely, and then just having the grit to soldier on and keep learning. Here, he's basically applying his investment rule to his personal life. Associate with high-quality people. He learned a long time ago to only get into business with people he genuinely liked, trusted, and admired. It's a simple rule, but it makes life so much richer and saves you a ton of headaches. And finally, there's this, a quote that really captures the sense of ethical duty he feels. This wisdom, which he often credited Munger for reinforcing, is all about recognizing that if you achieve incredible success, you have a responsibility to give back to the society that made it all possible. And so, that leaves us with one final massive question. The principles seem simple enough, right? Be patient, buy quality businesses, think for the long term. But as Berkshire enters a new era without Munger and eventually without Buffett, you have to wonder, is the philosophy itself the magic formula? Or was the incredible, unparalleled success of Berkshire Hathaway just the unrepeatable result of two brilliant, once-in-a-century minds working together for a lifetime?